Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by our view on the domestic debt markets, which could in turn impact the positioning of our schemes. The 10-year benchmark U.S. Treasury yield remained largely flat during the month and closed at 4.20%, approximately 5 bps lower than previous month. During the month, 10-year U.S. Treasury yields traded in a range of 4.07% to 4.32%, majorly driven by change in expectations of policy rate cuts during the year based on the Federal Open Market Committee policy, Fed governors' speeches, and macroeconomic data releases. FOMC maintained its policy rate and its projected policy rate for the current calendar year, CY. It, however, revised the real GDP projection upwards, moderated their projection for unemployment rate, and revised the core personal consumption expenditure inflation projection higher for CY 2024. The Fed acknowledged that it would have to dial back policy restraint at some point this year, and also foresees to reduce the pace of balance sheet runoffs in the near future. 10-year sovereign yield in Germany also softened by approximately 6 bps, closed at 2.35% versus 2.41% last month, primarily attributable to weaker macroeconomic data points. Labour markets in Eurozone and UK showed signs of slackening weakness. UK unemployment rate at 3.9% for January 2024 versus 3.8% expected. Composite Purchasing Managers Index, PMI, was weaker than expected in UK, though remained in expansionary mode. Retail sales contracted on a year-on-year basis, -1% for January 2024 in Eurozone and -0.4% for February 2024 in UK. The Bank of Japan, BOJ, raised its short-term interest rates to around 0% to 0.1% from negative 0.1%. The central bank raised interest rates for the first time since 2007, ending the world's last negative interest rate regime on early signs of robust wage gains this year. It also announced the abolition of its yield curve control policy for 10-year Japanese government bonds and intends to gradually reduce purchases of corporate bonds. Domestic 10-year benchmark yield remained largely flat, fell by 3 bps during the month, in line with the limited movement of global yields in the corresponding period. GSEC issuances of rupees 7.5 trillion in first half year 2025, or 53.2% of its gross borrowing target of rupees 14.1 trillion came in lower than expected, causing yields to rally by 2 bps on the last working day of the month. The 10Y GSEC traded in a narrow band of 7.05%, 7.11% and closed at 7.05% in March 2024 as compared to 7.08% in February 2024. CPI inflation for February 2024 printed at 5.09%, almost flat from the January 2024 reading of 5.10% but marginally higher than Bloomberg's median poll of 5.04%. Food and beverages inflation remain a cause of concern as February 2024 reading stood at an elevated level of 7.76%, higher than 7.58% in January 2024. Within food and beverages, vegetables, pulses, and products and spices have been observing double-digit growth in inflation for a consistent period of time. CPI excluding food and beverages stood at 2.81%, below 4.0% for the sixth consecutive month, the lowest reading since November 2019. Core inflation moderated further in February 2024 and stood at 3.34%, lowest reading in the 2011-12 CPI inflation series. Liquidity conditions eased in March 2024 due to improved government spending and liquidity injection of rupees 40,000 crore as RBI took delivery of the USD $5 billion rupee swap conducted a year back. Outflows related to GST, advanced tax and financial year-end, however, led to some tightness in liquidity in the latter half of the month. Average systemic liquidity deficit for March 2024 stood at rupees 41,478 crore, substantially lower than the deficit of rupees 1.86 lakh crore in February 2024. In March 2024, daily average of weighted average call rate was at 6.61%, lower than 6.63% in February 2024. Adjusted for the government cash balances which are held by the RBI, the durable liquidity remains in surplus. Credit growth stood at 20.4% as on March 8, 2024 on a year-on-year basis, marginally higher than 20.3% in February 2024. On the other hand, bank deposits grew by 13.7% as on March 8, 2024, marginally better than the month-ago level of 13.6%. Global yields remained relatively flat during the month, as rate cut expectations for 2024 were largely unchanged. Economic indicators continue to show a mixed picture with no clear indication of the direction in which the economy is headed. The inversion of the 2-year versus 30-year remained at around approximately 29 bps. US 2-year closed at 4.63% versus US 30-year at 4.35% in March 2024. The intent of the Fed to achieve long-term inflation rate of 2.0% on a durable basis remains crystal clear. With better than anticipated economic growth and tight labor market, the Federal Reserve gets additional time to carefully analyze the developments in the economy before deciding on the rate cuts trajectory. U.S. Federal Reserve does not seem to be in a rush to cut rates. However, it highlighted that the need to cut rates would arise sometime this year. Three conditions that make the path for the Fed to start cutting rates much easier are: 1. With the backdrop of strong fiscal spending, keeping interest rates higher for longer increases the burden of the interest expense on U.S. government. 2. Real interest rates are significantly positive. Currently, real rate in U.S. is at 3%, that is interest rate at 5.5%. PCE for February 2024 at 2.5%. 3. The U.S. Fed's dual mandate of maximum employment with price stability eludes the possibility that an unexpected weakening of the labor market can induce Fed easing, while solid job growth may not deter the Fed from pivoting if inflation is trending lower. However, scenarios of what can go wrong over next few months and the associated risks that remain are: yields at the longer end in U.S. may remain elevated as supply-side pressures persist, i.e., likely strong supply of coupon-bearing instruments due to the elevated fiscal deficit. The table below shows how the composition of bills have increased while notes have fallen over the past decade. Given Japan's recent policy decision, yields of JGB may remain elevated, causing Japanese investors to further withdraw funds invested in UST as spreads compress. It's pertinent to note that Japan is the largest foreign holder of UST at the end of December 2023. Upside risks to inflation remain given the geopolitical conflicts. Crude oil increased from USD 83.62 billion to USD 87.48 billion. Copper prices surged by 4.1% during the month, a signal of potential inflation and robust economic health. In an attempt to spur growth, People's Bank of China has recently cut its policy rate by 25 bps in February 2024. While China recovers, inflation may begin to trickle in, thereby exporting inflation to other countries. On the domestic front, reasons driving the bulls are lower than expected supply in first half financial year 2025, borrowing numbers after a lower than expected fiscal deficit, fairly positive real rates, and foreign inflows in anticipation of bond index inclusion from June 2024 onwards, which can result in a positive demand-supply equation. As per the budget, the fiscal deficit for FY24 was revised to 5.8%, with gross market borrowing for FY25 pegged at rupees 14.1 lakh crore. Net borrowings for FY25 is pegged at rupees 11.75 lakh crores. Out of a gross borrowing target of rupees 14.1 trillion for FY25, only 53.2%, rupees 7.5 trillion of GSEC issuances is expected in first half financial year 2025. On the flip side, reasons for being cautious in India are that globally rates remain elevated even after recent softening in rates, domestic inflation is susceptible to volatility due to food components, and domestic growth remains resilient. We see a softening bias in yields in the visible future and have shifted to the higher end of the duration with a buy on every dip mindset. However, we have chosen to add duration through liquid instruments and stay nimble-footed in tweaking duration if needed given the risk highlighted above.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.